it. Are you team set it and forget it or team fast and furious? When it comes to investing, your timeline is everything. Do you see yourself building wealth slowly over decades, or are you looking for quicker gains? Today, we're diving deep into the world of long-term versus short-term investing. By the end of this video, you'll know exactly which path is right for you. So, stick around as we decode the strategies, the risks, and the rewards of both. Let's start with the classic, the marathon runner of the investing world, long-term investing. The philosophy here is simple but powerful: buy and hold. You're not just buying a stock, you're rebuying a piece of a business that you believe will grow and prosper over many years, maybe even decades. Think of the legendary investor Warren Buffett. His strategy isn't about jumping on the latest hot trend. Instead, he meticulously researches companies with strong fundamentals, a competitive edge, and solid leadership. He buys them with the intention of holding them for a very, very long time. This approach is all about patience and harnessing the magic of compounding. Compounding is when your investment earnings start generating their own earnings. It's like a snowball rolling downhill, getting bigger and bigger over time. A small amount invested early can grow into a massive sum given enough time. For example, investing in a broad market index fund like the S&P 500 has historically delivered an average annual return of around 10%. If you just stay invested through the ups and downs, the long-term trend has been overwhelmingly positive. The beauty of long-term investing is that it's less stressful. You don't need to watch the market's every move. Daily price swings, scary headlines, and market noise become less important. Your focus is on the big picture, the long-term growth potential of your chosen assets. This strategy is perfect for major life goals like retirement, buying a home in the distant future, or funding your children's education. It's about planting a tree today so you can enjoy its shade many years from now. Now, let's shift gears to the other side of the track: short-term investing. This is the sprint, not the marathon. Here, investors aim to profit from market movements over a shorter period, anything from a few days to a year. Instead of buy and hold, the motto is more like buy low, sell high, and do it quickly. This isn't about the fundamental value of a company 10 years from now. It's about predicting where the price is headed tomorrow or next week. There are several strategies under the short-term umbrella. Day trading involves buying and selling securities within the same day, hoping to capitalize on tiny price fluctuations. Swing trading is a bit slower, holding positions for a few days or weeks to ride a swing or a short-term trend in the market. These strategies often rely heavily on technical analysis, which means studying charts and patterns to predict future price movements. It's more about market psychology and momentum than it is about a company's balance sheet. Short-term investing can be incredibly exciting and potentially very profitable if you get it right. You could see significant returns in a much shorter time frame than with a buy and hold strategy. However, let's be crystal clear. the risks are substantially higher. Trying to time the market consistently is notoriously difficult, even for seasoned professionals. You're competing against sophisticated algorithms and institutional investors. One wrong move or an unexpected market event can lead to significant losses fast. It's a high-stakes game that requires a lot of knowledge, a strong stomach for risk, and a significant time commitment to constantly monitor the markets. So, let's put these two side by side and look at the key differences. The first and most obvious is time. Long-term investing is measured in years and decades. Short-term investing is measured in days, weeks, or months. This difference in time horizon directly impacts your strategy. Long-term investors focus on fundamentals. Short-term traders focus on technicals and market sentiment. Next up is risk. While all investing involves risk, the nature of that risk is different. With long-term investing, the main risk is that your chosen assets don't perform as expected over time. But history shows that diversified portfolios tend to recover from market downturns and grow over the long run. For short-term traders, the primary risk is volatility. You're trying to predict unpredictable short-term movements, and it's very easy to get caught on the wrong side of a trade. The potential for rapid loss is much greater. Let's talk about everyone's favorite topic, taxes. This is a huge, often overlooked difference. In many countries, including the US, there's a big tax advantage for long-term investors. When you hold an investment for more than a year before selling it for a profit, you're typically taxed at a lower long-term capital gains rate. However, if you sell an investment you've held for a year or less, that profit is considered a short-term capital gain and is taxed at your regular income tax rate, which is almost always higher. So, short-term trading not only involves more risk, but can also lead to a bigger tax bill eating into your potential profits. Finally, consider the time and emotional energy required. Long-term investing can be relatively passive. Once you've set up your diversified portfolio, you might only need to check in and rebalance it once or twice a year. Short-term trading, on the other hand, is an active hands-on job. It requires constant attention, quick decisions, and the emotional discipline to handle both big wins and crushing losses without letting it affect your judgment. It's a high-stress environment that is definitely not for everyone. So, how do you choose? The answer lies in your personal circumstances and goals. First, what's your financial goal? If you're saving for retirement in 30 years, long-term investing is almost certainly the way to go. You have time on your side to ride out market volatility and let compounding work its magic. But if you have a specific goal to, say, make a down payment on a car in 6 months, short-term investing might seem appealing, but the high risk means you could also lose that money. A high-yield savings account might be a safer bet for such a short timeline. Second, what is your risk tolerance? Be honest with yourself. How would you feel if your portfolio dropped 20% in a week? If the thought makes you want to curl up in a ball, high-frequency short-term trading is probably not for you. A more stable, long-term approach would be a better fit for your peace of mind. And third, how much time and knowledge do you have? Are you passionate about spending hours each day analyzing charts and reading market news? If so, you might have the dedication required for short-term trading. But if you have a demanding job, a family, and other hobbies, a passive long-term strategy is far more realistic and sustainable. In summary, long-term investing is like planting an orchard. It takes time, patience, and a belief in future growth. But the potential harvest can be life-changing and relatively low. Short-term investing is like being a day trader in a bustling fruit market. It's fast-paced, exciting, and you can make a profit quickly, but you can also end up with spoiled goods if you're not careful. It demands constant attention, skill, and a high tolerance for risk. For most beginners, the evidence overwhelmingly supports a long-term approach. Start by building a diversified portfolio of low-cost index funds, or ETFs, and commit to adding to it regularly. This is the most proven path to building sustainable wealth over time. As you gain more knowledge and experience, you can decide if you want to dip your toes into more active, short-term strategies with a small portion of your portfolio that you can afford to lose. Ultimately, there's no single best way to invest. The best strategy is the one that aligns with your personal goals, your tolerance for risk, and your lifestyle. Understand the game you're playing before you start. Choose your timeline and then build a strategy that fits it. Thanks for watching. I hope this breakdown helps you on your investment journey. If you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit that notification bell so you don't miss our next video. Let me know in the comments which style of investing you prefer and why. See you next time.